Hello, welcome back. Mike from Canavan Wealth here. I wanted to do kind of a recap of what's going on so far with this most recent economic downturn that started in kind of December of 2021 and dominated all of 2022, and we are certainly still in the middle of in 2023. I think we're long enough into this that's pretty meaningful to talk about how we got here and what's been happening, because it might be a little surprising to you, some of these numbers. So where did it all start? It all started with inflation going up, which of course you can date back to COVID and all sorts of reasons, but we see inflation start to rise, not dramatically in 2021, but definitely dramatically in 2022. We see it peak around 9% here in the US. If you average it throughout the year, it's I think somewhere around 7%. You can see that, for the most part, inflation's been bouncing around in the 2 to 4 or 5% range since back in the 80s, when inflation was famously very, very high, as well as the 70s. And, well, really the 70s. And then in the 80s, it starts coming down. So what did we do? Jerome Powell, kind of the face of the Fed funds rate these days, starts raising what's called the Fed funds rate, or sometimes referred to as the overnight rate. This is the minimum interest rate you can imagine that banks and the Federal Reserve will lend money to each other for short periods of time. So if a bank, to meet various policy requirements, needs a loan of a few $1,000,000, they will, loan it to each other via this rate. So this is kind of the lowest rate you could expect to get on any type of a loan or interest payment. So this is us kind of raising it back before the 2008 global financial crisis. We lower it down dramatically to try and spur economic growth. When money is cheap to lend, companies will typically have an easier time building new factories, creating new jobs, and spurring the economy. So this is one of the, lowering the Fed funds rate is a way that we commonly spur the economy. And then we start raising interest rates, and then COVID hits and we worry about the economy. So they dramatically lower the Fed funds rate almost back down to zero again. And then inflation starts getting really bad. So we start raising the Fed funds rate with an attempt to cool the economy, right? So we have the goal there is to slow the aggressive spending so that the money slows down and inflation does not get quite as bad. And we are still raising it. If we look at this kind of over the last year, we've been raising it steadily. The last one was a very short one, but we do expect probably at least one more raise out of the Fed. And then they have been very close to their chest about what the future is past that, because as you will see, this has a dramatic impact on the economy. So this is the bond market. I think one of the stories here is to kind of understand what happened to the bond market through all of this. So initially, when you think, oh, interest rates have risen, bonds must be doing better because they pay higher interest rates. But it's important to remember that new bonds only pay higher interest rates. Your old bonds pay whatever it was that you signed up for when you bought it. So bond indexes and bond face values, which is what you would get if you sold the bond, they actually go down when interest rates go up. So it's not hard to understand it when you really start thinking about it. If you have a bond that pays 3% and interest rates go up to the point that a new bond pays 6%, your bond is not very attractive to investors. So it's, in order to sell it to them, you have to discount the bond, which is its face value, which is why bond values have dropped through this time period, despite the fact that interest rates have gone up. And you can see this is the Barclays Ag, which is a very complicated index, but you can think of it as kind of an average of the bond index. And, they dropped dramatically, dropped really, really low towards about October, and then they've come up a bit since then, largely as we expect interest rates to kind of start leveling out. The other place you'll see this is the 10-year Treasury. So this is the yield on the 10-year Treasury, not the face value, which is why the graph's going to look the opposite. It's going to be going up. So, in 2022, we start raising the Fed funds rate, which of course drives the price of treasuries pretty dramatically. And the 10-year Treasury gets as high as about 4.2 and then has started coming down. Now, this is interesting because the Fed funds rate, if you look at it, let me go back here, back in October, it's still been going up since October, but the 10-year Treasury peaked in October and has actually started to come down. Why is that? That's because A lot of people are believing that interest rates are going to start leveling off because inflation has started to come down. And if interest rates level off, then the Fed will eventually get around to their long-term goal of getting interest and inflation below 2%, which means dramatically lowering the Fed funds rate back down. Now, that could be 6 months, that could be 18 months, or 5 years from now. It's tough to speculate exactly when that's going to be. We see that repeated in the 3-year Treasury here. So here is 2022, and you see it dramatically come up. It also peaks around October and then comes back down to 4.1. Now, this is a very interesting phenomenon for the same reason. This is called a yield curve inversion. So right now, if you went out and bought a 10-year Treasury, you'd be paid 3.6% on it every year for 10 years. If you went and bought a 3-year Treasury, you get paid more at 4.1%. So why would anyone buy a 10-year Treasury at 3.6 if you could buy a 3-year, have your money tied up for a shorter time period and get a better interest rate? Well, you have to think about what's going to happen in 3 years when you go to possibly renew that bond. So you get your money back, and now you got to go buy another bond. And most likely interest rates at that time, at least billions and billions of dollars are betting on, those interest rates are going to be dramatically lower than what they are now. So the reason you would buy a 10-year is because in 3 years, you won't have to roll that money over to a new bond and possibly only earn 2% instead of 3.6. But this is something that's called a yield inversion, which happens when shorter term bonds yield higher than longer term bonds. It's generally viewed negatively when it is not directly impacted by the Fed funds rate being raised or lower as aggressively as it is now. Really now, because we're reaching the top of this and because most of the money in the world is being bet on the fact that the Fed funds rate will come back down soon, I'm not sure I really personally see this as the doom and gloom that often you will see, in headlines on the Wall Street Journal, like yield inversion imminent, hide your children. But you can see here back in 2021, where as the length of the bond gets longer, the return gets better. Whereas at the end of 2022, the exact opposite is happening. It's actually early 2023. As the bond duration gets longer, the yield actually gets lower. And this is probably, I'm not sure this is a doomsday. It's certainly not how most of the media outlets are selling it. All right, where your average consumer sees the impact of the Fed funds rate is undoubtedly their mortgage. If it's variable or if you're opening a new mortgage, you will see mortgage rates go up dramatically. This is something we're going to cover in the very near future here about the housing market in general and what's going on through this downturn. But this is the 30-year fixed rate mortgage kind of average. You can see it being very high back in the 70s and 80s when inflation and interest rates were so high that we saw in those graphs earlier. And then steadily come down to very, very low record low interest rates. I refinanced all my houses during this time. And then here you can see it peaks at around almost 7%. I think it actually went above 7% for a little bit, and now it's down to about 6.5. So it's dropped pretty dramatically in the last few months, again, because of the perception of where interest rates are going. But it's really not at a crazy level. We're still really now just above where we were in the early 2000s. Is it as low as it's been? No, but it is not in a place where it dramatically changes the economic benefits of owning versus renting. And you can see that, and this is new residential sales. So this is COVID. We see a downturn, but then we have the great migration as people start going remote work, as offices start closing and people have more flexibility on where they want to live, they start moving and lots of home sales. And here we are now after a year of rising mortgage rates. The question becomes, is it really that bad? We're kind of back to pre-pandemic new home sales. This is not like we've fallen off a cliff or anything. So the concern is that the housing market was going to fall apart with rising interest rates. And I was one of the concerned. It really hasn't happened. All right, now the stock market, I'm sure everyone sees it in their 401k or their investments, has certainly taken a brutal beating. The S&P 500 was up around 4,700, now down around 4,100, so 600, about 15%, somewhere in there. Still down since December of last year. But I think one of the interesting things about this downturn is how dramatically different the various stock sectors performed. Specifically tech. So this is the NASDAQ, is what I usually talk about when we talk about tech. This is the 100 largest company on the NASDAQ, which tends to be focused in that area. Was up in the 16.5, now down to 12.4. So it's down about 4,000, almost 25% still down. At the lows here, I think it was down in the 33% down. I think the S&P 500 at its lows was in the 23% down. This was, of course, mostly due to reduction, not mostly, but a big reason here was reduction in online advertising revenue in the big advertisers like Google and other people, that Facebook, things that operate in the internet space. If you're a company that is worried about a recession coming and you want to tighten your belt, kind of cut your budget, one of the easiest things for you to do is turn off online advertising, where you probably spend a lot of money these days, because part of the benefit of online advertising is how flexible it is. Whereas more traditional marketing, TV commercials, things like that, billboards, those are long-term contracts that are, if you get out of them, you may not be able to get back into them. So you'll typically will wait to turn those off before you'll, just quickly turn off online advertising, which made revenue go through the floor for a lot of these companies when they saw this coming, and their shares got beaten down quite badly. Now we're looking at the Dow. So this is typically an older index, holds, I think, more value stocks than the others. It tries to be indicative of kind of the entire economy. S&P 500 is typically kind of seen as a growth index, although there are a lot of value stocks in it. Peaked out in kind of December, October, January, that kind of frame around 36,000, down around, let's say 34, so down maybe 2,500. Less than 10% from last January, last October, or 2 Octobers ago. So this is, it did drop quite a bit. I think it did hit around 20% down, but has come back really well. The value stocks did very, very well last year compared to tech or, the S&P 500. Outperformed the bond market, right? We saw the Barclays Ag earlier. That was way, way down. So this is about risk. I think my March webinar is going to be about risk and talking about, what being conservative means these days and what is and is not risky. I think that'll be a great seminar. So that really kind of recaps what I wanted to just talk through. I will probably do these hopefully, in another 6, 12, 18 months as we see the full story of this economic downturn, kind of play out, because I think it's interesting to see. It looked really, really scary when we were at the bottom, and I can't promise that we won't see another bottom, but as it plays out, it's really not looking as scary as it could have, especially with things like the housing market and interest rates. And inflation is definitely coming back into play. So I hope this was informative, and I will talk to you soon.